Finance textbooks often show the following graph, where you can see that the risk goes down as you have more and more stocks in your portfolio. I agree with this, but only up to a point. I'm about to share 3 simple but super powerful diversification strategies that I feel everyone should talk about, but almost nobody does. When most people picture diversification, they think of a mix of stocks, bonds, real estate, gold, and crypto. While this may be partly true, it's only half the story. In this video, I'm going to break down those overlooked areas of portfolio diversification and why they matter than most people think. And stick till the end, because I'm also going to share with you how many stocks I feel should be in a diversified portfolio. Hi, welcome, namaste, guten tag, ciao, dobar dan. If you're new to the channel, my name is Niranjan. I've been investing in global equity markets for almost 20 years. My goal is to achieve financial independence through passive income, and I'm here to take you on that journey with me. For my first tip, I'm going to tell you an anecdote. Let's rewind the clock back to 2020. COVID had just hit the world. Stocks were volatile. There were days I remember where the market was falling 5, 6, 7, and even 10%. So there I was, ready to pounce. I had my laptop ready, my strategy prepared, the money on my account, and I was ready to buy those stocks at mouth-watering valuations. So what happened? Well, the brokerage platform that I was using froze. So I was frustrated and I didn't know what to do. Well, a week later, markets went down again. And yet again, my brokerage platform froze. And that's when it hit me. I was making a rookie mistake. I was putting all my eggs in one basket, depending on a single platform. So what did I do? Shortly after that, I opened my second brokerage account with another company. Because if your main platform crashes, if you're locked out, if you can't access your funds, if you can't sell or buy a stock, you should always have a backup platform to place your trades on. Think of it like this. You wouldn't like to have all your cash under a single mattress and then your house catches fire. And let's be honest, setting up a brokerage platform isn't rocket science. For those living in Europe, there's Trade Republic for beginners. And for more experienced investors, there's Interactive Brokers. Of course, there are other platforms, and let me be open, no platform is sponsoring or making me say these things to you. The next tip is a pretty simple and straightforward one. Today we live in an era of constant information, misinformation, disinformation, and as some people would like to call it, fake news. So what do I mean by this? Well, I'm not relying on all my information when it comes to investments from a single source. Of course, I'm reading the Wall Street Journal, the Financial Times, Yahoo Finance, but I'm also listening to various YouTubers, podcasters for their views on various topics of interest. But here's the key. I'm not just listening to some famous analyst on TV who says, hey, buy XYZ stock at $100. I'm more interested in the reasoning and what's behind their train of thought. In fact, some of the best insights I've got isn't from traditional legacy media. It's more from YouTubers and podcasters. And if you're curious on everything I read, I've put a list in the description below. And now let's get to the third tip. One of the questions I get asked the most is how many stocks do I hold in my portfolio? And with this question comes how many stocks should there be in a perfectly diversified portfolio? Finance textbooks often show the following graph, where you can see that the risk goes down as you have more and more stocks in your portfolio. I agree with this, but only up to a point. This is my graph for a perfectly diversified portfolio. As you can see, the risk is at the minimal point at X, and I define X as the number of stocks I'd like in a portfolio with minimal risk. But if I hold more than X stocks, you notice that the line starts going upwards. Why? Well, my definition of a portfolio with an ideal number of stocks is the number of stocks I'm willing to read about, where I know the financial information, where I'm able to track the details of this company every day and follow up and do it periodically. If I'm not willing to do that on a regular basis, perhaps I shouldn't be owning so many stocks. In fact, for a lot of us, perhaps just owning a bunch of ETFs may be better, where we are not forced to keep track of stocks and their movements every single day. So needless to say, if one holds too many stocks beyond a certain point, your risk exposure is actually going up. It's not coming down. Nobody can convince me that an individual who has a full-time job can hold 100 stocks in their portfolio and keep a track of those 100 companies. It's almost mission impossible. So to conclude, my strategy for portfolio diversification are multiple brokerage accounts, multiple sources of information, and a number of stocks in the portfolio or a number of securities that you're able to keep a track of on a regular basis on your own. What do you think about all this? Leave me a message in the comments below. Thanks for watching. Until next time, I hope your investments are safe and profitable.